The stock market crash was a result of many factors, such as the economic crisis, the housing bubble burst, and more. In this video, we will discuss these factors and show how they led to the stock market crash. The first factor that led to the stock market crash is the economic crisis. The economic crisis was a result of many different events that happened in 2008, such as the housing bubble burst. The stock market crash of 1929 is considered by many to be the most devastating crash in modern history. It marked the beginning of worldwide economic depression, and the years that followed were very difficult for Americans. Today, we're witnessing some of the same symptoms that occurred before 1929. We have a growing wealth gap and people are overextended on credit. Plus, there is increased speculation in stocks based on short-term performance rather than solid fundamentals. One way to prepare for an economic downturn is to make sure you have enough cash on hand to cover your expenses for at least 6 months. This money should not be invested in risky investments like stocks or bonds because it may be needed in case you lose your job or otherwise need to rely on it sooner than expected. In addition, having 6 months of living expenses in cash can help you stay financially strong no matter how the economy shifts over the next few years. The crash of 1929 and the Great Depression that followed had an enormous impact on the global economy. The U.S. government responded by passing new laws and regulations to protect investors, consumers, and businesses from such a collapse happening again. The stock market crash was caused by several factors: insufficient regulation of Wall Street, a lack of oversight over investment banks, lack of transparency in corporate accounting practices, unrealistic expectations about future profits. Today, we are facing similar economic conditions as those during the stock market crash of 1929 over a short period of time. Interest rates have been lowered to historically low levels, which has led to excessive borrowing and risk-taking by investors. This has made the markets incredibly volatile. The Federal Reserve is worried that if it doesn't intervene in the market soon, there will be another financial crisis like the one seen before. However, if they continue with their policy of low interest rates for too long, it could lead to further asset bubbles and an even more severe collapse when these bubbles burst. The current economic conditions that led to the stock market crash and why it's dangerous. The economic situation in the United States has been extremely volatile for a few years now, and there are many questions about what is going on. The most important of these questions is, will the economy continue to improve? Some banks have failed, while others were saved. Congress passed a stimulus package, but you probably know little about it or how it will affect your finances. The National Bureau of Economic Research has determined that we are still in a recession despite what the government says. In fact, they've determined that we have entered into a depression because of how severe this recession has been. The impact of this economic crisis continues to grow as more and more businesses fail, more people lose their homes, and more jobs are being lost each day. This means that our economy remains fragile despite what anyone else says. The time to act is now.